Welcome to the first session we have today at the Better Investor Conference, and we're going to look at building a share portfolio for generational wealth. Now, everybody wants to leave a legacy for their loved ones and the generations to come, and we will unpack the opportunities, the things to do and when to do it to build that portfolio. And we will focus on an equity portfolio. And with me is Renier de Bruyn. He's a senior investment analyst at Sanlam Private Wealth. And he joined Sanlam Private Wealth in 2010 as an equity analyst, and he has been co-managing the multi-asset portfolios with the Director of Investments since last year. He's a CFA charter holder. He has an advanced postgraduate diploma in financial planning from the University of the Free State. He acquired that cum laude. He also has a BCom Honours in financial planning cum laude. Renier, thank you so much for joining us today. Let's just set the scene. Many people would look at a portfolio for long-term investments, and I think the key question is just what is the difference between building a portfolio for your retirement so that you can retire comfortably and building a portfolio for generational wealth? Are there key differences between the two?
Good morning, Ray. Good morning, everyone. Thank you very much for this opportunity. So, let's distinguish between a portfolio for generational wealth and one for income for retirement. So, I think the first big difference is that if we talk about generational wealth, that really is referring to your assets that are in excess of those that is needed to fund your retirement. So we're really focusing on long-term capital growth here, while if you compare that to a portfolio for retirement, that is much more income focused, where you need to draw income over the shorter period. So the mix of assets will change then. For a income portfolio for retirement, you would focus a lot more on fixed interest, while if we're thinking about generational wealth, we're thinking about the assets that will produce the best return over the long term in terms of capital growth.
So there's most definitely a much longer term investment horizon. So how do you approach it? When do you decide, let's start with this, and what are the key things you need to consider?
So I think firstly, let's think about which assets do well over the long term. So I think if I can go into maybe the first slide. If we think about, so the normal, when we think about portfolio construction, we first think about what is your objectives, what is your time horizon. So in this case, thinking about generational wealth, we're thinking of a very, very long time horizon, certainly one that surpasses your own life expectancy, so that you can pass on sizable assets to your heirs, who will then be in a position to use that to their own benefit, whether that is to start their own business, fund retirement, fund a property, pay for education, that sort of thing. So, so focus on the long term. Then we also have to think about when we construct a portfolio, what is your focus on risk or your toleration of risk. Now, I think there's a clear distinction if we start thinking very long term how we should think about risk. Because normally we think about risk as, the certainty and the volatility of returns. So, for example, if we think about something like the money market, that is a very predictable, safe return that one can get. But then you can think about equities, which actually do better over the long term. But that is at the cost of more uncertainty over the short term, because in the shorter time frame, the returns you can get from the share market is a lot more uncertain and volatile, as opposed to, let's call it, safer investments from a volatility point of view. However, if we start thinking long term, I think you have to start thinking differently about risk, because your risk is not as much about volatility, because you will be able to ride, you have to be able to ride through the inevitable volatility that the market will provide. Your long-term risk is more about the impact of inflation over time. So if you just think about 1960, if you had 100,000 Rand then, 60 years later, that is just in terms of the impact of inflation, what you could have bought was 100,000 in 1960, now need 10.6 million rand. So over time, your real enemy is actually inflation. That's the primary risk. It's not volatility of returns. Secondly, your other long-term risk is investing in assets that underperform.
Well, it's quite clear that equities have outperformed the other asset classes significantly, but I'm sure that the dividends play a significant role. That income you receive during the period and the accumulated profits you make, and that has a significant impact. How big is the impact of the dividends on the total performance, especially looking at that graph, because it looks really, really, really significant?
Yeah, so on this chart, you can see that if you invested 100,000 in 1960 and you invested that in, say, the money market, you see that you get a very predictable, steady return, and that 100,000 would have grown into 34 million rand. But I'll just remember the impact of inflation, which would be worth then 10.6 million. So basically, if you invested in money market, a very comfortable, smooth ride. But over this little bit more than 60 years, your wealth would have increased about three times in real terms. However, if you put it in the equity market, that 100,000 would have grown to 1.2 billion rand, which in real terms, so that is if you remove the impact of inflation, your wealth would have increased about 120 times. But very interesting enough, this is if you include your dividends. If you exclude dividends and you basically just did not reinvest your dividend, your return would have been actually less than what you see here in the gold price. So that but if you look at the own market, your dividend yield would have been on average around 4%. And that 4%, if you just that incremental return, if you compound that over a very long period, that becomes a very, very important part of your total return eventually.
But that makes a massive difference. There's a big difference between 1.2 billion and, if I heard you correctly, a return, if you didn't invest, dividends of less than what the gold price appreciated with. So that must be one of the key focus areas.
Yes. So right. So that just shows you the importance of dividends and reinvesting that over time. And once again, you can invest in companies that grow over time and pay less dividends. Naspers is a good example. And then you have got other companies, say, for example, like the banks, where the growth is lower, but you actually get quite a good dividend yield. If you just look at our banks, for example, it's difficult to really get excited about them. But just if you just look at any given period and you see how much of that total return that you receive is actually through dividends. The banks have done remarkably well relative to the market on a total return basis, while the returns don't always look that great, just if you look at the share performance themselves. So certainly something you should not be neglecting. And once again, if you think about constructing a good share portfolio over the long term, one of the key ingredients, and I think we'll talk about that a little bit later, is to focus on companies that are very highly cash generative. And if you can pay a good dividend, that's usually a sign that the company is cash generative. And as we've shown here, that becomes a very important part of your return, especially over the long periods.
But looking at that graph, it shows you that volatility, short-term volatility, does not really have an impact. And I would assume the longer the investment period, the less impact volatility has on the total performance. I know you've got a new slide or another slide showing that, and it's actually quite, evident that risk and volatility reduces over time.
Yeah, so that brings me back to the point I've made earlier, is that if you often have people coming to me and asking me, they've got, say, saved up a deposit for a house and they want to buy this house in 1 year's time. Should they invest it in the stock market and try to increase the value of their deposit? And my answer usually is, I don't know, and I wouldn't recommend that, because if you think about what the market can do over any particular 1 year period. So this is just the range of returns of our market since 1960. So your worst return over any 12-month period was minus 48%, and you certainly don't want to have that kind of return if you just save a deposit and see that value erode by half over one period. And on the top end, you could have received 125%. So from this point of view, it's a risky asset class from a volatility point of view. But once again, if you start thinking longer term, and certainly when we're thinking about generational wealth, that means we start thinking about time horizons in excess of 20 years. And you can see how the range of outcomes, so this is return, including dividends per annum, actually narrows over time. So if we define risk according to volatility, that risk actually reduces over time. And you can see the worst return you received out of the JSE All-Share Index was 12% per annum over the last 20 years, and the best 26%. So the worst return would have outperformed the other asset classes. And that is why if you start thinking long-term, really equities become your best bet. However, that is if you have invested in the index.
Just can I ask you to go back to the previous slide, because there is a silent killer, and that is inflation. Do you have any indication of the net returns after inflation, or the real returns, and how the equity market outperformed inflation?
Yes, so in this particular chart, we've assumed you had 100,000 invested in 1960. That 100,000 adjusted for inflation today would have been 10 million rand. So that is, you can make the comparison. So if you think about the money market index, you have 34 million rand now if you invested 100,000, but inflation is worth 10 million rand. So that means you've got basically 3 times inflation. That is the increase in your real value that you can buy with your assets. And you can see that big difference if you actually invested in equity market, just materially. So even though this return in the money market looks very interesting, moving from 100,000 to 34 million rand, your real increase in wealth is not nearly as much because of inflation taking away so much of your returns. That is why we said, like, over the long term, volatility is not really the big risk. It is things like investing in assets that don't perform well, and then also the impact of inflation. However, investors should understand that if you take this half, where we see that equities over a long period has consistently outperformed, it does come with more, let's call it, it will test your nerves. Because there were times, like I've showed in the next slide, that the market comes down by 48% in 12 months period. And that is often where investors who had a plan with equities fall by the wayside because they simply can't stomach that volatility. And often then they sell at the wrong time. And that becomes material destruction to your wealth over long terms. So I think, once again, if you invest in equities for the reasons of building long-term wealth as the preferred asset class, you must be prepared more emotionally than anything else to be able to suffer those drawdowns and still believe in that case for equities.
Most financial advisors will tell you, listen, diversification, diversification, diversification for any investment portfolio. Now, looking at that graph, it seems like, I would like to have all my money in equities. Of course, you can diversify within an equity portfolio, but do you think building a portfolio for generational wealth would then guide you to invest much more in equities than, say, in a portfolio for retirement?
Yes, absolutely. So, once again, the first few charts that we've spoken about, that refers to the market in general. And obviously, if you build a portfolio, you have basically 2 options. You can buy the market. That's quite easy to do. So you can buy the index, and the cost of that is coming down all the time. So it's quite an efficient way to invest the market with one share, like a listed ETF. or you can actually try to pick the shares yourself. Now, I think if I just talk to this slide that's currently on it, and what I've done here is I've just looked at the last 10 years, and I look at all the shares, all the companies that was included at any particular point during the past 10 years in the index, and look at what the total return was for that share over the last 10 years. And I didn't put the names down here because it would be a little bit too messy. But you can see what I've also done here is I've shown you the return of the all shares. So over the last 10 years, your total cumulative return for the market, South African market, was 153%. And now you can compare that all the companies inside our market, what their returns were over the last 10 years. And you can see the best return here, which was Capitec, that had a return of 1,100% over the last 10 years. But then you can also see there's quite a big tail of companies that firstly did worse than the market, and that was the majority of companies underperformed the market. And you can see there was quite a big portion, probably around 40% of the market that gave you a negative return. And you can see even here there were a bunch of companies that almost where you lost all your capital. So once again, if you picked the wrong shares, and that could have been quite easily, because if you randomly picked, you had a 75 or at least 75% chance of picking shares that did worse than the market, you could easily do worse. So just to say equities outperform over time doesn't mean all equities outperform over time. And if you didn't have some of these big winners that basically drove all the returns of the market, your returns would have looked much different. So I think, and this is just over the last 10 years for the South African market, but if you do the same exercise for different markets or different time periods, you get the same answer. It's usually a very small percentage of the companies that drives all the returns of the market over a particular time period. So the question is, how do you make sure that you've got the winners and not the losers? And I don't think it's that easy, because I think if we maybe talk to some of the winners and losers on this chart and see, what are the lessons that we can learn here in terms of what are the common characteristics of the winners and what are the common characteristics of the losers. So let's start so if we say, okay, we don't want to be passive, and remember, I think this chart actually makes a big case for passive investments, because especially if you are a private individual investor who doesn't have full-time ability or to really to analyze every company in detail, investing in the index is a sure way. Even though if you invest in the index, you'll end up with quite a long tail of investments that don't do great, but at least you are certain to have these big winners. And if you have a company that does 10 times your return, then you can have quite a few companies actually where you lose money. So if you had Capitec and you had Steinhoff in equal amounts, you still have had a good return, even though you had to write off one of the assets over time. So you have to have those winners. But I think if we say, okay, I don't want to be average, I want to be an active investor, let's see how we can at least try to avoid the losers. So there's two common characteristics in the losers here. The one is leverage. So if you think of companies like into properties, which basically got delisted, you had something like Steinhoff, you had Bright, companies where you lost more than 90% of your money. There were different reasons. In Steinhoff, there was accounting fraud. Some of the other businesses perhaps made one or two poor acquisitions. However, the thing that really resulted in this massive drawdown was the fact that there was leverage on the balance sheet, so a lot of debt, and eventually they couldn't service that debt. And then when you get into that position, you're either a forced seller at bad prices, or the creditors really take over the company at the expense of the shareholders. So once again, and then if you look at the companies that were the big winners, almost none of them had high levels of debt. So they didn't require debt to get their returns. It was really about operational excellence. And the other sort of common characteristics of companies where you've lost money over time were often companies that had good reputations. They were performing well, but the share just became too expensive. And after that, it resulted in poor returns. Things like Acura or a company like Aspen, which over a very long period captured the imagination of investors because of strong operational performance as well as share performance. But since then, because you're starting from a very expensive base, your subsequent returns become quite poor. So the big lessons to learn out when you do your own stock picking: firstly, avoid companies with too much debt, and do not overpay for companies. And once again, if you look at the market, there are always these two big emotional drivers. Let's call it biases that investors have, and usually that it accumulates, or it builds on itself, and that is fear and greed. So greed, we saw that say in the crypto space all over.
Can I interrupt you there,
yes,
Renier,
sure.
because I want to go back to this chart because it's very, very interesting. If it was that easy to pick winners, looking at debt levels and the relative PE ratios to indicate whether they are expensive or not, most professional fund managers also don't beat the index. And it is very, very difficult to do. So the question arises, so if you do pick a winner, how long do you hold it? And how do you take your churn decisions and switching out of certain shares and going into others? Do you approach that differently with a portfolio to build generational wealth? Do you hold on longer onto those shares? Or how should you look at it?
I think that's a great question, because if I look at our own client base, so when we look at our own client base, you've got the two groups. The one where we manage the client's money with our own decisions. We call that discretionary managed portfolios. And then we've got a group of clients who do their own trading. And we basically just act as a stockbroker. And if we look at the clients that do their own thing, and unfortunately, it's a small percentage that really outperforms the market. But generally, those who do really well and have built, let's call it generational wealth, were usually those that had that one company for 20 or 30 or 40 years that just compounded and did very well and eventually became 80 or 70% of their portfolio. So very undiversified portfolio, which an active manager wouldn't want to own it in such a way. But yeah, I mean, those are the Capitex, the Naspers, the old Rembrandt group of companies. Investors who stayed with those companies over a very long period did very well. But once again, I mean, for every one of those success stories, there were multiple that amount of companies over time that did not outperform. So maybe those were the outliers. But getting back to your question, when you sell a winning company, so I think I would actually think about differentiate it in two groups. So if we look at the South African market, we are, at least in international terms, have quite a cyclical market. So we've got a lot of mining companies, we've got a lot of financials, for example. And those companies may not necessarily do that well over the long term, but there are up and down cycles. And that is where we as active manager focused a lot of our attention to sort of try to have the companies at the right point in the cycle. So even though the company may underperform over time, they can do well in a particular cycle, and then you can outperform during that time. So if we have a company that's sort of more mature and cyclical, I would say if you have a valuation on the company, that is where we focus, and you get to that valuation, you should sell it. Okay. Yeah. Don't try to bet on it, keep on going higher and higher. Maintain valuation discipline. But I think often you have those companies that are more structural growth. So they might be still a little bit small, but there's a lot of market runway for them. The two examples of the strong outperforming companies in this group was Clicks and it was Capitec. And they both had relative decent market shares, but they were so good in their particular market, and they would just keep on growing their market share. And even though those companies looked expensive in traditional measures for a long period, if you sold them, you would have sold them to it. So let's distinguish between those two companies. A mature company, you sell when you get a decent price and you've made your money. I think when you have a structural growth company with clear market share runway, I think keep that a little bit long.
Yeah. Maybe it's age, but can I ask that the questions, and I see they are coming in, and please keep them coming, events at moneyweb.co.za. Email us your questions or post it in the chat box on the YouTube channel. I will put them to Renier. Renier, many people will tell you the investment universe is really not limited to South Africa. If you sit on Mars and you look at South Africa or the world and you want to invest, a very small portion of that investment will be in South Africa. So from the perspective of building this long-term financial legacy you want to leave, how should you look at geographical diversification?
Okay, that's a great question. So maybe just to put it in context, I've got a slide here that shows you the relative size of the market, and that is our home ground, and that is the companies we know and love. But it's important always to understand perspective. If we just look at the JSE and we look at the free float market cap, so those are the freely trading shares, in billions of dollars, we've got around $880 billion of tradable shares. That is only 1.2% of the tradable shares out there in the world. So once again, if you just define yourself to the South African market, I think you lose out on a lot of opportunities out there. And I think also if we think about the South African market, on the next slide, I just showed you the makeup of our market. So we've got, you can see here our own market versus the MSCI World. So that's developed market equities. You can see we've got 38% of our market is in the mining sector or in the resources sector, versus the world is only 8%. So we are materially overexposed to the mining sector. And we know that the mining sector, even though it's gone through a few years of strong outperformance, we know that it's a very deep cyclical, very cyclical industries. So if you invest in most of your money in the all share, just understand that your fortunes are a lot more tied to specifically what happens in the resources sector. And then if you compare, say, to some of the more what we traditionally call defensive sectors, so like the consumer defensive, you can see that we are a lower weight, and certainly in healthcare, where a lot of the new innovation globally is happening. Unfortunately, we've got a very small weight in healthcare versus a much larger weight in the world. And also the other big difference, if you think about the fourth industrial revolution, we've got the traditional old economy businesses such as mining, such as financials. We have a very big weight there in the South African market. But if you think about the new generation technology business, there we actually have a big shortage of companies. It's only really Naspers and Process that operates in that space. So just once again, just an argument to think more globally when you think about. Obviously, if you invest globally, I think you must make make sure of the structure you invest in, because it brings other technicalities. But I think one of the panelists will address that issue later today.
Of course, as you've said, we see many cycles. Resources, for example, in South Africa, they performed very poorly for about a decade, and then suddenly there was a surge, and it really performed well. We've seen it in the technology sector in the US. Of course, there's some pressure on many of those big companies currently. But should you try and time cycles? I know timing is a swear word within the investment world, but how should you work that into a strategy?
Yeah, I think it's very difficult to get timing right. Obviously we as active managers do a lot of effort in trying to understand what we call the market cycle. and trying to be in the specific sectors at the right time in the cycle. We know that we will not get it right, but if you get it 60% right, I think you can add value. And I think if you look at the South African market, you have no choice but to sort of try to understand and play the cycle a little bit more, because we know that resources generally are not a structural outperforming sector over the long term. So you're probably not going to beat global equities over the long term, and resources certainly haven't done that. Over the short term they have, so they have these cycles when they do phenomenally well. So I think sort of the approach that we have in our business is to sort of be a little bit counter-cyclical. So you should sort of understand, where we are in the cycle, whether, say, commodity prices are high or low. If they are low, then we would try to invest more in the sector. And if the prices are high, we'll try to reduce our weighting in that sector. So we have to play that game in the South African market. Often, if you look at global managers, they don't really do that because the universe is much different. So they can invest more in these, let's call it boring quality compounders over time, where you actually get good returns over the long period. But that is a different game.
Well, that brings the question, are there more defensive sectors? And obviously there are many volatile sectors. How do you balance that long-term portfolio? How much do you allocate towards a more defensive sector, maybe like property, as opposed to something like technology and resources?
Yeah, so I think when you build a portfolio, you have to have a few principles. Once again, I think they say diversification is your only free lunch in investments. The fact is, like most people, no one can really forecast the future with accuracy. Everyone tries, and we always listen to gurus and people trying to explain to us what is going to happen around the corner. But if you look at track records, no one really in this world has been able to consistently predict market cycles over time. They were the one or two that were lucky, and then they became gurus overnight, and people started giving them too much attention. So having said that, I think that is the case why you need to have diversification. And often my view is that, if you have a diversified portfolio, but once again, diversification means not only, between, say, bonds and equities. It means within equities, you need to have exposure to different sectors. And also to different geographies, because you don't know, for example, we had this Russian invasion. So everything that you had in Russia became worthless overnight. And you don't want that. So you have to spread your assets over time. But when you buy assets, I think with every asset, you can make sure that the fundamentals are in place, that the valuation that you pay are appropriate. And that over time, all those assets should do well for you. However, they will not necessarily perform during the same environment. And once again, say, for example, you have some more defensive kind of businesses in your portfolio, and the world goes into a very difficult time period. We know that defensive shares will outperform you during that time, and then you can actually sell those shares and buy the other, let's call it more cyclical shares, when you're in a crisis period, because those things will become will sell down more, and because you have a diversified portfolio, that will actually allow you to capitalize on the market opportunities over time, and then you can outperform the market. But you need to have the currency, so you need to have assets that will hold up your portfolio in difficult times, and not only to make your portfolio more resilient, but actually to give you the war chest to capitalize on the opportunities. And a lot of people build wealth over time. You usually see the rich people, they enhance their wealth when the world goes through difficult times, because they're the ones who capitalize on the opportunities.
Can I ask that I get the questions here on the big screen? As I've said, age is a cruel thing. But a question from Sean. Life still happens when building generational wealth. So do you ring fence certain assets with shorter time frames, or do all assets sit in equity, long only?
Yeah, I think that's a great question. So I would say that the one thing with equities is that we know the bus is going somewhere, okay? But we don't know the journey. But you as an investor always want to make sure that you can choose where you want to get off at that bus. You don't want to get off at the bus at the wrong place. So with equities, when you invest in equities, you have to have a mindset that you can stay there for long term, and you don't want any life event to force you to sell equities at the wrong time in the cycle, because then you will destroy all the relative impact or relative benefit that equities have over time. So I would say that if you think that there might be any withdrawals, you should not keep that into equities. You should keep that into fixed interest, where you've got predictable income. So for example, your emergency fund that you have, which I think most people should have, or at least, maybe you've got a home loan, you just have maybe you pay your home loan down a little bit faster, and then you can access that equity, for that. As opposed to putting that in equities and being a forced seller at the wrong time.
Another question is about the exchange rate. Of course, the rand is very, very volatile. It has been one of the most volatile currencies in the world for many, many years. So how should you look at the investment currency, and how important is that in formulating the strategy?
Yeah, so that is very important. So you have to, when you invest, you have to think about what currency you're going to measure yourself in. And that currency should really be where you're going to spend your money going forward. So if you plan on immigrating, then you have to start thinking in the currency of the country you're going to immigrate, and make sure that your assets perform according to that currency. If you're a South African investor and you plan to spend your retirement here, you have to think of your returns in terms of rand returns. But I think there we actually have a great benefit in terms of just how the rand operates, because it allows you to mix your assets globally in quite an efficient way. If I maybe can elaborate on that. So if, for example, usually when the world goes into a tough period, what traditionally happens is the rand weakens. If the rand weakens and you hold offshore assets, the weaker rand actually safeguards your portfolio in that regard, because the weaker rand leads to higher returns on your offshore assets. So that is a great benefit. Obviously, in the good times, the rand tends to strengthen, and then you want to have, say, South African bonds, South African banks, retailers, that sort of thing, would do very well then over time. So I think you can play the balance, and the rand plays an important shock absorber really in tough times. But to get the benefit of that, you have to have offshore assets. But once again, I mean, to be honest, if you think about, even if you invest in the JSE All-Share Index, I think the last calculation we did is that 70% of the revenue is actually offshore, non-rand earnings or non-rand revenues for the market. So even the all-share is already quite a big rand hedge, or carries a lot of rand hedge benefit for us. So I think the typical South African investor, when they invest in local equities as well as global equities and other assets globally, it's got quite a good diversification, and I think the rand is actually a benefit in terms of smoothing out returns over time.
Let's talk about risk, because I think many investors they can't marry return and risk. In many cases, people take too much risk, and in many cases, too little risk. So how do you marry the two, especially within this long-term investment horizon, which forms part of the strategy?
I like that question a lot, because the one thing you said is, like, some people take too little risk. And that is, as I said, over the long term, what is risk? Risk is not volatility over the long term. Risk is inflation and poor performing assets. So once again, if you want to minimize long-term risk, you have to minimize two things. You have to make sure you beat inflation, and not every asset does that. And you need to have, let's call it, more perceived higher risk assets like equities, like property, which outperform inflation over the long period, but comes at the expense of shorter term volatility. So that is the one thing. So I think that your question is really, how do you define what is the appropriate risk to take? I think I would sort of approach it in a way that let's break up your investment horizon into shorter pieces. So what is your 1 year investment horizon? So those are the assets that is for emergency fund or the income that you need out of your assets over the next year. And then how is it over 2, 5, 10 years, 20 years, 30 years, 50 years? And then really, if you start thinking about the assets that are earmarked for, say, periods longer than 10 years, the majority of that should be in equities, because that equities, and when I call equities, remember diversified equities, because you can be in the wrong equities as well. But equities, because your risk that you want to beat over long term is inflation. But over the short term, your risk is absolutely different. It is what the markets will do over a short period when equities are a lot more unpredictable. So then your risk that you manage is volatility, and there you need to have safer investments. So for shorter term investment horizon, have fixed interest and money market, longer term property and equity.
Then many investors can't do this on their own. They need an advisor, an asset manager who walks this journey with them. But in many cases, picking the right asset manager is a challenge. So how do you think people should consider which advisor and asset manager to use to achieve the best results?
Also a good question. So I always like diversity. So I would spread my assets across good asset managers. I often see, unfortunately, investors and sometimes the advisors, hopefully to a lesser degree, makes a lot of mistakes along the way. So you might start with a very good plan, but so many people get sucked into the past winners, and often, say, a particular manager has outperformed or performed well, and another one, which is probably also a good manager, had very poor performance. But they might have different styles or different focus areas, and the market environment was just more supportive for the one and the other one. And then often the mistake is that people think now, because this one had good performance, he's a better manager. And then they sell the poor performer one and buy the one just as the cycle turns. Or they start out in equities, and the first market crash comes along and they said, this is too risky for me. And then they sell at the bottom and put it in the money market. So I often think that the best plan is to, and that is where advisors should earn their money, is more on the emotional side, because I don't think it's rocket science to put together a good, solid plan for an investor. You have the right asset allocation mix. You make sure you have enough exposure to long-term growth assets, but then you need to stay the course. But it is emotionally difficult. And I think that, once again, advisors that is the key job, is to make sure that when the environment is difficult, that they stick to the plan.
How important is tax planning as part of building such a portfolio? Because I think if you change or switch regularly, there may be a capital gains tax impact. And, how should you consider that?
Yeah, so whenever you make an investment decision, there are actually two decisions you make. So the first is, what are the assets that you invest in? And I think most of the time now we've spoken about that side of it. But then the second is, how should you package that asset? And there are plenty of options, and each one has their own tax impact. And it's very particular to an individual client, his own tax situation, etc., etc. So, if I can just name a few examples. You own equities or you own a balanced portfolio. That balanced portfolio could be held directly as a discretionary money. It could be in a retirement annuity. It could be in a living annuity. It could be in an endowment. It could be in a company. It could be in a trust. It could be in a company that is owned by a trust. So there are many parts, but that is also a very important part of your financial planning, to make sure that when you own the right assets, you own it in the right structure. And once again, becomes very particular. I can't give advice in general. That is often where you need to have a financial advice. And unfortunately, the industry, for a person that's perhaps not in the industry, the rules become quite complicated and many things to consider. And that is maybe also where a financial advisor plays an important role to make sure that you package your assets in the correct way.
Interesting question. Is there room for derivatives within such a long-term portfolio?
Yes. Yeah. If you ask Warren Buffett, he would say definitely no. I think, like if we think about derivatives, really what derivatives achieve, the derivatives can achieve two things really. I mean, you can use it as a way to increase risk. So in other words, you leverage, you use it as debt to increase your exposure to assets. So that means your returns are higher on the upside and lower on the downside. Or you can use derivatives to mitigate risk. So you can sort of use it to provide insurance or protection. It comes at a cost, but to actually smooth your return. So it depends on the context you have. And often, it depends on the market cycle. So, for example, if you had very high returns in the market, it looks a little bit frosty, you can actually use derivatives, but I would use it, say, you use hedge funds, which would provide better protection when the markets draw down. But then, obviously, when markets are cheap, you can use leverage to increase your returns going up. So it's not something that I think you can use. You can say, I must use it consistently. The one very important takeaway is, just remember, when you are invested in equities, inevitably there will be difficult times when markets are full. And the one thing you don't want is to be a forced seller when markets are low. And often if you use derivatives, the markets come down, you get margin calls, and now you are forced to give more margin, which you may not have, or you're forced to sell the share at the bad time. And often if we think about companies that start doing badly, and the share becomes so cheap, then you often see people with big positions with debt funding, and then the banks come in and they call on that debt, and then they force you to sell at the bottom, which depresses the prices even more, and then you do some serious wealth destruction at the wrong time. So if you use leverage or use derivatives to add leverage over time, just make sure that once again, your portfolio are prepared for those drawdowns, and you have got enough cash available to service that debt.
Then how good are South Africans at building such portfolios, building generational wealth? Obviously that is a very interesting strategy, but how good are they?
Yeah, it's difficult to answer that quite generic. But unfortunately, if you look at the statistics and you look at, look at unit trust. Now, you've mentioned that it's very difficult for most asset managers to outperform the index by themselves. And then you look at how the investors in those funds do relative to the funds that difficult to outperform. Unfortunately, the investors do even worse than the funds for the reasons we spoke earlier about, where they always try to run after the past winner, and they sell their losers at the wrong time in the cycle. So unfortunately, it's easy to make mistakes in the market. And once again, a key takeaway for me is, beware of emotions, because your emotions, and we also come to that, makes you are generally wired to make bad investment decisions, unfortunately. I think once again, get back to what I think you should do is make sure you plan, get the structure right of your portfolio, make sure you've got diversified assets with enough exposure to growth assets for your long-term money, and then you stick to that plan. And make sure that within the managers you use, you also diversify.
Renier, we'll have to leave it there. Thank you so much for sharing your insights with us. That was Renier de Bruyn. He's a senior investment analyst at Sanlam Private Wealth.